Yeah. So my first question is that when we look at the SBI's growth rate for advances specifically, that was pushed specifically by the agri and SME segment. So do you think such growth is going to sustain? And do you think the asset quality will remain as strong as what we have seen in this quarter?
So the growth rate, if you look at it, is at about 12%. The corporate loan growth is at about 9%. The retail loan growth is at about 11%. I believe SBI should grow nearby to this 11-12%. That's how the system growth is, and SBI should nearly about mirror that growth. As we come on asset quality for top banks has continued to remain strong. Similarly, for SBI, it will continue to remain very strong. The slippage ratio has come about at about 0.42%, which is similar to what it was the last year. So asset quality is not a problem for SBI. It will continue to remain strong. As smaller banks continue to struggle, the larger banks will continue to win.
Okay, so another question I have is that now board has also approved around 25,000 crores of capital raised via equity. So how do you see this? Because when we look at SBI, earlier it was noted that there may be a requirement of CET enhancement, but earlier management said that it is not required, but now they are coming up with equity fundraiser approval. So how do you see that?
So if you look at all the top banks, top or large private sector banks as well as SBI, you will look at it, SBI's CET1 ratio is at about 10.81%, which is the lowest amongst all banks. Bank requires capital in order to grow further from about 10-12% to about 15-18%. So this is a good move, positive move. This will enhance the capital requirements of the company, and equity share sale would be a good opportunity for domestic mutual funds and DIIs to get in to buy into SBI. So this is positive for SBI from a capital and a growth perspective, and positive for the mutual fund and the DII industry that a good bank is coming out with a share sale.
Okay, another question that I have is that we already have some comments from the SBI's press conference. What the SBI's management is saying is that loan book growth can actually moderate to around 10-12% versus the run rate that we have seen at around 13-14% for SBI. So given that it is the biggest bank of India, do you think there could be some pressure across industry as well in terms of loan book growth?
So loan growth is a consequence of one or two factors. Point number one is how good is the retail customer coming into you. If there is a problem with the retail customer, the bank will tend to slow down the loan growth. Also, the system-wide, larger banks are supporting loan growth, and the smaller banks are really struggling at this point. So from my perspective, SBI will grow at one time the GDP growth. Today, the nominal GDP growth is at about 10-11%, and that's where I expect SBI to be. Of course, the larger banks will continue to grow at about 15-18%. SBI will mirror what the GDP is really doing. So I expect somewhere between 8-12% growth from SBI year on year.
And Aditya, while you're here with us, let's also focus on the Kotak Mahindra Bank, another big bank for the weekend. When we look at the numbers, inline set of numbers is what we have seen. But specifically in terms of advances, Kotak's growth has been at around 13.5% versus what we have seen. The rate was a little high. So do you think it is actually that the bank is being a little cautious maybe, or they are focusing more on secured and not growing their unsecured? What's your take on this?
So as we see the slate, you will find that the unsecured retail book has degrown by 33%. The credit card has grown by 7%. So what is happening is Kotak is trying to move towards the secured side of it. We've seen this pattern with Kotak. Whenever they see a system-wide NPA, they tend to slow down the unsecured book and move towards the secured book. So nothing to complain about as such. 13-14% growth is fair enough. But in the coming quarters, Kotak must accelerate this in order to support the stock price. Otherwise, the stock price will languish if the growth does not come back.
And in terms of net interest margins as well, if the Kotak Bank is moving more towards the secured rate, it has kept their NIMs unchanged, at least for the year, on a year-on-year basis. But do you think there may be some pressure because we also have seen the rate cuts and 50 bits of more rate cuts is what we are expecting?
Yeah. So I don't think that Kotak's net interest margins are going to materially move on 10 to 15%, 15 basis points erosion in net interest margin is something which is really very normal. Mind you, Kotak operates as the highest margin across the industry per se. So So I don't think that is a real worry per se. What I would more be interested on is how they're going to ramp up the 811 and the credit card engine now that the ban is really gone. How are they going to ramp up the low cost deposit franchise that they have created, and what's the roadmap there? So that is the more interesting point that I would be interested in. Net interest margin, I don't think would be a problem for both.
All right. Thank you, Gaurav and Aditya Shah, for your perspective on what we saw in terms of these numbers for both SBI and Kotak Mahindra Bank. But on that note, that's all I have for you in this edition. Thank you for watching.